A bank in Singapore approved a 95 million trade finance loan for a shipment of luxury goods that never left the warehouse. Actually, there was no warehouse. There were no goods, no shipments, no seller, just a piece of paper and a stamp. And the bank wired the money anyway. Today, I want to walk you through one of the most sophisticated and honestly embarrassing blind spots in global banking. It's called trade-based money laundering, and specifically a version of it so brazen that compliance officers who study it still can't believe it worked at scale for years. The question I want you sitting with for the next few minutes is this: how does 95 million disappear through a loan for something that doesn't exist and nobody noticed? By the end of this video, you'll know exactly how, and you'll never look at a trade finance application the same way again. Let me start with the basics. International trade is one of the most complex financial ecosystems in the world. Every day, trillions of dollars in goods move across borders: electronics, pharmaceuticals, luxury goods, and raw materials. And every one of those shipments comes with paperwork: purchase orders, invoices, bills of lading, letters of credit. Banks finance this trade. A company says, we have a 2 million shipment of electronics coming from Hong Kong. We need a loan to cover it until we receive and sell the goods. The bank reviews documents. The documents look right. The loan goes through. Now, here's where it gets interesting. What if the goods don't exist? This is what's called a phantom shipment or a ghost transaction. It is the crown jewel of trade-based money laundering. Here's the basic architecture of how it works. And pay attention, because this is where your wait, what moment is going to happen. Step 1, a criminal already has dirty money: drug proceeds, fraud money, sanctions evasion funds. The problem is it's basically sitting somewhere it shouldn't be, and moving it directly looks suspicious. Step 2, they set up a shell company, sometimes two, one as the exporter, one as the importer. These entities look real. They have websites, tax IDs, even small transaction histories. Step 3, the shell companies generate fake trade documents: a purchase order, an invoice for, say, 10,000 units of industrial electronics, a bill of lading that appears to show those goods were loaded onto a container ship. The paperwork is convincing because it's modeled on real trade documentation. Step 4, they take those fake documents to a bank and apply for a trade finance loan, a letter of credit, or similar instruments. The bank, reviewing the documents at face value, approves a loan and releases funds. Step 5, the money moves across accounts through multiple jurisdictions, getting layered and mixed with other transactions until it's nearly impossible to trace. The criminals pocket the proceeds. The shipment never arrives because it never existed. And the bank, well, it's left holding a loan on goods it can never be repossessed. Does that feel like it should be impossible to pull off? Because here's the part that should make every compliance officer uncomfortable. FinCEN reported in 2024 that trade-based money laundering related suspicious activity reports were only 2% of fentanyl-linked filings, but represented 42% of the dollar value, 42% of the money, 2% of the flags. That is the gap criminals are exploiting. They're moving the biggest amounts through the channel we're watching least carefully. Now, let me bring you back to Singapore, because this isn't a hypothetical. Between 2010 and 2017, a network of shell companies operating with fictitious trade identities submitted fabricated invoices to multiple banks, claiming to ship luxury goods that never moved. The result? Over 95 million in fraudulent trade finance loans. The documents looked right. The parties appeared legitimate. The trade routes weren't flagged. Nobody connected the dots until they did. And by then, the money was gone. Has this ever happened to a bank you've worked with or a correspondent you dealt with? I hope your compliance team sees this. Now, this isn't just a Singapore problem. UAE linked cases have shown widespread phantom shipments and forged invoices running through electronics and consumer goods trade. Goods that are easy to over-invoice because their prices are highly variable and difficult to benchmark without specialized data. And the methods extend beyond pure ghost deals. Over-invoicing. The goods exist, but the declared value is inflated. If a shipment of phones is worth $500,000 but invoiced at $1.2 million, the extra $700,000 moves as if it's legitimate trade revenue. Under-invoicing. The opposite. Deflate the value to shift funds covertly to a foreign counterparty at a discount. Multiple invoicing. The same shipment is invoiced to multiple banks or lenders simultaneously. Full phantom deals. No goods at all. Just paper and wire transfers. And here's what makes this so maddening to detect. Trade data is siloed. The bank sees the invoice. Customs sees the shipment manifest, maybe. The shipping company has its own records. And none of these systems talk to each other in real time. Criminals built their playbook around that gap. Which brings me to the question I've been holding for you. What should have been caught? Here's exactly what the red flags look like. And honestly, once you see them, you can't unsee them. Red flag 1, invoice to document mismatches. The invoice says 10,000 units of electronics. The bill of lading references a container with a declared weight that couldn't physically hold 10,000 units of that product. Those two documents came from the same criminal and they still didn't match. Cross-reference every time. Red flag 2, trade routes that make no economic sense. Goods manufactured in China, shipped through 3 intermediary jurisdictions, destined for a buyer in Central Europe for a commodity that's available directly. Why the detour? Ask why. If the answer is vague, that's your answer. Red flag 3, high value, low volume commodities. Electronics, pharmaceuticals, luxury goods, jewelry. These are favorites precisely because their per unit values are high and variable. A single shipment can carry enormous dollar value with very little physical footprint. Red flag 4, repeated transactions between the same counterparties. If the same exporter and importer are running trade finance transactions through your institution repeatedly, especially in a short window, that loop is worth scrutinizing. Real trade relationships exist, but criminals reuse their fake infrastructure. Red flag 5, shell entities in high-risk jurisdictions. One party is an entity registered 6 months ago in a jurisdiction known for corporate opacity. No beneficial ownership disclosed. No operating history. And they're the counterparty to a $3 million trade deal. That alone is a flag. So what does good due diligence actually look like here? First, cross-reference invoice values against commodity price benchmarks. There are trade databases that track going market rates for specific goods. If the declared price is significantly off, ask for justification. Second, Verify the physical plausibility of the shipment. Does the container size match the declared volume? Does the shipping timeline make logistical sense? These are basic questions that get skipped under time pressure. Third, know your counterparty beyond the name on the invoice. Who owns the company? Where do they actually operate? What's their transaction history? Beneficial ownership transparency is non-negotiable in high-risk trade relationships. Fourth, look at the economic logic. Is there a real business reason for this trade? Does the profit margin make any sense? Criminals building phantom deals often overlook the commercial plausibility. A deal with no realistic profit motive for the importer is worth questioning. And fifth, share intelligence. TBML is almost impossible to detect in isolation because the scheme lives across institutions, jurisdictions, and data systems. Public-private information sharing, cross-border coordination, and SAR analysis are how this gets caught. Back to that 95 million loan. The documents looked right, the parties looked real, the trade route wasn't flagged. What was missed? Well, a shipment with no matching logistics data, shell entities with no operating history, trade values that didn't hold up against market pricing, and counterparties who had no real reason to be in business with each other. The money disappeared not because the scheme was genius. It disappeared because nobody asked the simple questions. If you work in trade finance, compliance, or correspondent banking, I hope this landed somewhere useful. Share this with your team. Tag someone who reviews trade documents and has never thought about phantom shipments. The criminals already know how this works. Now you do too.